Hello everyone, welcome to the seventh lecture of our RBWM revision series. Today we'll be revising the unit 7 of our module B, that is credit scoring. So what is the meaning of credit scoring? The credit scoring companies, how do they utilize the history? How do they provide the credit information report? How can we maintain a good credit score? What are the advantages of the good credit score? All of these things we are going to cover. So what is credit scoring? Why credit scoring? What are the benefits to the customers and the banks through the credit scoring? All right. So basically we can say that credit scoring is a analysis that will allow the lenders and the financial institutions to conduct, basically to assess or access the credit worthiness of the individual. They can decide whether they will extend or refuse credit to the particular individual. So many things, many factors like the payment history, the types of credit availed so far, new credit, current debt, the length of credit held, all of these factors will be taken into consideration. The main motive of credit scoring is basically to manage the risk. We cannot eliminate the risk in the banking segment, but we can manage it, we can minimize it, right? So there are different types of risks that the banks face. We have the credit risk where the consumers fail to pay, business risk, losing money due to the wrong strategy, market risk, change in the market prices, and operating risk, processing failures and frauds. Right? So here we are focused on this credit risk where the customers they fail to pay. Why is it important to manage the credit risk? Because banks business, it depends upon the loans that they're extending. If they do not get the repayment, from where will they make further loans? Right? It will cause a loss of profit to the banks. Thus, we cannot eliminate the risk completely, but we can manage it better. We can minimize the risk by looking at the credit score of the individual. To obviate these risks, professional appraisal is important for the sanctioning of loan. And for this, the concept of credit scoring has been developed. So, credit scoring is the statistical analysis of a person's past credit dealings. It represents her or his credit discipline. So, let's say in a customer's profile, there are mainly the unsecured loans, there are mainly the credit cards. They have been applying for too many loans. There have also been default or irregular payment, delay in the EMI payment. All of this will give an idea to the lender that this customer is a risky customer. There are more chances that a default might occur. So, to minimize those risks, the bank can refuse to extend credit to that particular individual, to that particular customer. Or the interest rates can be high, or the monitoring can be more strict, right? So, the credit score is assessed on the past dealings in the credit card products like home loans, auto loans, credit cards, personal loans. And these scores can be generated by the credit institutions themselves, or RBI has made it mandatory for all the credit information companies. These CICs, they are professionals. These companies, they prepare the credit report and they will have to give a free full credit report without any charge on request once a calendar year to the individuals whose credit history is available. So any person can check what is their credit score. This rule has been made by RBI. Once a calendar year, free of charge on request, the FFCR has to be provided by the credit information companies. Okay, so we can say this credit score, it will give us a view, a snapshot of the consumer's credit report, right? Credit report is a detailed report. It will contain all the credits, all the loans that the consumer has taken, details about all the delayed payment, details about all the unsecured loans, everything. But the credit score will basically be an overview. It is a 3-digit number which represents the amount of risk. It is a rating, right? So, whenever I am, let's say, availing any service, I'm going to eat out in a restaurant, I will see what is the rating, whether it is 4 star, it is 5 star. Similarly, this rating is of the customer's credit history. The credit score value range from 300 to 900. Mostly a score above 700 is considered good by most of the banks, but again, the risk perception is different. It will vary from bank to bank. RBI has directed that CIR in respect of the borrower will incorporate all the credit information when they are the consumers, they have taken any loan for the commercial purpose, everything. All the information related to the consumer's credit history should be included in the credit information report. If we talk about the evolution of credit scoring, the CICs have been established in India. It has been, the credit scoring has been followed from way back in through many years in many countries, right? The what is a good credit score we just discussed, it is based upon the bank's internal policy, the customer's profile, as well as risk appetite. Some banks, most banks will perceive 700 as a good score. Any other bank might not consider it as a good score. All right, so it will vary from bank to bank. Now, if we talk about the credit scoring model, we said it is a statistical method, a mathematical model. We are converting the qualitative information into a quantitative score. It is used to estimate the probability of default. We cannot 100% say that the customer is going to default on the payment or not. Only the probability, the chances that the customer may trigger a credit event like a bankruptcy, obligation of default, failure to pay. So the probability is presented in the form of the credit score. Higher score refers to a lower probability of default. All right, so the CICs, they mostly take into consideration the defaults on the previous credit transaction. What is the payment behavior or the payment history? Are there any delays in the payment? Are they due to genuine reason or willful reason? The previous searches or inquiries, right? So the CICs, they are known to include the high utilization of credit. This means, let's say my credit card limit is rupees 10,000. This is my safe limit. I am using only 5,000. Then I am a safe customer. If my limit is 10,000, I'm not only using the complete 10,000, I'm also seeking further credit. I am over leveraging myself. So the percentage, the CICs, they will take into consideration the high utilization of credit limit, and they also consider the whether the borrower is having a higher percentage of unsecured loan or not. These two informations are mostly used. Okay, and then using this information, a quantifiable measure of risk is given by the CIC, right? So utilization of credit, payment defaults, all of these things should be taken into consideration. Then what is the positive side of credit score? If I have a good credit score, it will indicate a good character of the of my borrowing habits. So it will be an evidence of financial discipline. If the borrower has defaulted once or twice due to some genuine reason, due to loss of job, due to some medical expenses, something which was not under their control, then this will not impact their credit score. Longer the credit history, better. So one should be judicious about closing the old accounts and opening new ones. So these are the positive signs. What behavior will lead to a higher credit score? We also have some actions that will lead to a lower credit score, like craving for credit, applying frequently, unnecessarily applying for credit. Several new accounts have been opened, several new applications for credit cards have been filed. The length of the credit history is important. Older accounts are better. Trade attributes. Does the customer have a good mix of credit, or does it only include the unsecured loans or the credit cards? All right. So, a good credit score and the bad credit score, what will be the actions that will lead to a good credit score or the bad credit score? These are important. And if I maintain a good credit score, there are more chances that my loan application will be approved by the bank. The quantum of loan will also be more, and the interest will also be less. All right. Then we have the CICs. What are CICs? They are independent third party institution. They collect financial data regarding the loans, credit cards, financial information about the individual, and they share it with the members. Who are the members? Members are the banks, the NBFCs, they are the customers of the CICs. They want to have information about the customer's payment history. Presently, we have four CICs that are operating in India. We have the TransUnion Civil Limited, Equifax Credit Information Services Private Limited, Experian Credit Information Company, and the CRIF High Mark Credit Information Services. These have been granted certificate of registration by RBI. All right. So, any bank who wants to seek information about the customer's credit history, they can apply. Also, it is important, this guideline was given in the 2025 that the CICs may seek and obtain information from its members only. Only the credit institution. CICs cannot go and themselves collect information from the customers. No, only from the credit information. All the credit institution will become members of all the CICs. They are required to submit the data to them, data related to the loans that have been given, any new loan, the repayments that have been made, any aberration or any delay in the payment. From here only the CIC will collect the data, right? The CICs, they will also keep the data confidential. They will update them on a monthly basis or whatever intervals decided. All right. So all of these guidelines have been given by RBI as to how the credit information should be provided and collected. What will be the benefit of using the CIR? It will help analyze the financial standing. It will be better for the customer as well as the bank. If, as a customer, I see that I have a low credit score, I will try to improve it. If the bank sees that the customer has a very low credit score, they can refuse a loan. And then credit information, one can be in a good position to make decisions regarding availing new forms of credit. Factors that will lead to the favorable credit score we have already discussed: on time loan EMI payments, regular payment of credit card bills, right? Paying the credit card bills in full rather than only the minimum amount due every time, avoiding over leverage, maintaining strong financial needs. All of these will lead to a favorable credit score. Advantage: minimizing of the risk for the bank and maximizing of the satisfaction for the customer. That is all from our unit 7, credit scoring. It is important that you understand the meaning of the credit score, how the credit score is calculated by the CICs, how the banks they utilize the credit score, they have to provide the information to the CICs, what factors will lead to a positive credit score and what factors will lead to a negative or a low credit score, and what will be their impact. So that is all for today. And if you have any doubts, any queries, you can let me know in the comment section. All of these videos on a daily basis, these are for your revision. So make sure you go through all of them. If you haven't watched the previous sessions, the previous units, make sure that you take out time and watch these videos, because these are going to be very helpful in your revision. So that is all. Please like the video, share the video, subscribe to the Oliveboard JAIIB English medium channel, because every day these sessions we are bringing for your benefit only. So thank you so much. Now I will see you in the next session. All the best.